Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bill's back again for another podcast.
Andrew, we are definitely back again in the hot seat today because we are talking about something that's impacting absolutely everyone at the moment. So looking forward to getting into this and getting a bit more information out there and trying to, with some of the conversations that we've been having with people, trying to get some of the messaging across that we've been talking to people about. Andrew, what are we talking about?
Today, we're talking about what's currently happening in investment markets. It is a red hot topic and it is absolutely everywhere. Yeah, definitely seeing it on all media channels, on absolutely everything. There's, certainly been a lot of talk about investment markets. So we're trying to, sift through some of that noise and trying to really get to the crux of what's happening, what's causing it, and, obviously some strategies and ideas on what you can do moving forward and how you navigate your way through.
This will be a really juicy one to unpack. I mean, there's a lot of information here. There's definitely a lot of noise. Everywhere you look in the media, it seems to be a hot topic, and obviously because it causes so much emotional angst, there's obviously real loss in terms of wealth destruction and things like that. So we'll get a whole heap of information out there, and then at the end of it, hopefully provide some comfort around some of the strategies that we deploy and some of the things that we talk about with people around how you can, best prepare yourself and what position you can get yourself into to try and navigate through this as best as possible. Because I think that the truth is with all of this, we're kind of in this environment and there's not a huge amount you can do with it at the moment because whatever's happening, and that'll become evident once we jump into this, but it seems to be touching everybody regardless of sort of what aspect of the economy or your life stage or what cycle you're in with things. It seems to be impacting absolutely everyone. So really juicy one to unpack. Let's get into it. Andrew.
Yeah, well, I mean, I guess the headline, if you haven't seen it in the news, I'm sure you've felt it in your back pocket when you've gone to the grocery store. But really, the thing that's dominating headlines at the moment is inflation. That's really been the driving force behind probably all, if not the vast majority of, what we're currently seeing at the moment in investment markets. But inflation is high. We're seeing very high rates of inflation, both domestically here in Australia, internationally, not aware of really any major developed countries that aren't experiencing this issue at the moment. And that's really the key that's impacting some of the volatility that we're seeing around, investment markets.
Yeah, that's the one that touches absolutely everybody. And the risk and the concern of central banks right across the world is that if this gets out of control, it's hard to get the genie back in the bottle. So you need to act on it quickly. We'll talk a little bit about increasing interest rates, which is the mechanism and the lever that people are using or that central banks are using to try and control the inflation genie. But the real worry here is that it starts to run away and we can't bring it back down quick enough. The Australian Reserve Bank if you read the minutes like we do of the Reserve Bank announcements and stuff, the language that they use in there is pretty, I won't say strong, but it's evident that they're committed to doing whatever they need to do in order to get inflation back into its target range. And even with the US, who increased rates recently as well, you see that the minutes are the same. They're committed to doing whatever needs to happen in order to get inflation back in.
I mean, we saw the biggest increase in interest rates that, the US Fed has done for, I think it was 30 years. They went up, 0.75 this month, which was massive. I mean, here in Australia, we saw a 0.5% rise and we thought that was pretty large and we thought that was, pretty disruptive, but we're seeing an even larger interest rate increase by the Fed in the US. So definitely some interesting times at the moment.
One of the other things that's been throwing around, or that we've heard the terminology being thrown around in the media a bit, Andrew, is stagflation. Yeah. It's interesting when these things happen, you start to hear different words. I mean, obviously in our world, it makes sense. We understand what that is, but it's interesting if you're not in that world, these things just come out from left field and it's like there's a new definition for something all of the time. But run us through look, we don't know if that's going to happen, but just for the sake of our listeners, let's talk about what stagflation is.
So, stagflation is ultimately a culmination of three things happening at the same time. And that's inflation being high, unemployment being high, and economic growth slowing down. So the reason that stagflation is quite a concerning thing for markets is really they're things that ordinarily shouldn't and won't occur at the same time. You think about inflation remaining high or inflation being high. Usually inflation is high when people are spending money, when there's, abundance of money in the monetary system. But really, you don't expect unemployment ultimately be high in a period of inflation. At the same time, yes, it makes sense that when unemployment is high, economic growth is going to be slow. But, with all of those three things happening at the same time, what it does is it gives policymakers a really difficult decision, because you're pulling levers where ordinarily it would move one of those things, but it's moving both of those things in different directions. And it gives policymakers a dilemma in, okay, what do they do? How do they actually, navigate their way through this with such really differing impacts, or with, normally inflation being high, what you do is you increase interest rates, and all of a sudden, people have less money to spend, inflation sort of comes under control. But when unemployment is high, if you're increasing interest rates, there's a concern that, people aren't going to be able to meet their mortgage repayments, people aren't going to be able to repay their debts. And so it gives a real dilemma to policymakers as to what you do to navigate your way through it, which is why it's so concerning.
Yeah, I can easily see that being a real headache for a policymaker. But I guess the thing to point out is that we're not there. I mean, obviously inflation is high. We've still got economic growth, albeit, that's slowing. But unemployment, at least in the developed countries that we're looking at and closer to home in Australia, I mean, we're at the lowest unemployment rate that we've had for a long, long time. And we'll talk a little bit about supply chain issues and labour markets and things like that later. But I still think that we're going to continue to have low unemployment in Australia just because of supply of labour, and skilled migration is definitely not there yet. But yeah, it's interesting to point out stagflation. We're definitely not there, but it's interesting to talk about because it has been in the media a little bit of late as well. And talking about policymakers, I mean, the main method that they've been using at the moment to combat inflation, which we haven't seen for a long period of time, we've been in a low interest rate world, is increasing the interest rate lever. That has a direct impact for, I guess, household borrowers is probably the big one. That's the one that everybody seems to feel most and straight away. We've seen that closer to home in our business, where as soon as the Reserve Bank have announced an increase, phones started running hot, even though it was anticipated, even though that we knew it was going to happen, even though that we've had such a long period of time where interest rates have been low. People obviously don't like spending more money and not getting anything else in return. So they're still servicing their mortgage. They still own the house. It's just costing them more to do that because interest rates are more expensive. So that seems to be the tool that Reserve Bank and central banks around the world are deploying in order to get inflation under control.
And I think the other thing to note, especially when you're talking about, here in Australia, this is interest rates of a couple of years ago. Like, we're not talking about interest rates rising to historically high levels. Yes, they're rising at a more rapid rate, but we're not talking about, interest rates where historically they were at, only 1%, and now all of a sudden they're at, 5%, and people don't know how to afford their mortgage. We're talking about, an interest rate environment that we were in only a couple of years ago. So it's really easy to get caught up in the media dramatizing everything and the media rhetoric around things. And it's not to say that there aren't some concerns, and that, it's important to, look at your household budget and look at the affordability of your mortgages and all of that stuff. So I don't want to downplay that, but we're not talking about an interest rate environment that we haven't seen before, or that was so long ago that it's been forgotten. This fairly normal interest rates, we're still at a historical, low in terms of interest rates. And so if you're waiting for interest rates to decrease, I wouldn't be doing that. We're most certainly going to see interest rates continue to rise. But this isn't something that we, haven't seen before, that, borrowers haven't been able to deal with in the past.
And you're right. I mean, absolutely right. Everything that you said, but no one likes it anyway, right? So have to pay more for your mortgage and not getting anything else in return. Absolutely.
The stock market doesn't like it either.
No. Well, actually, really good conduit. Andrew, talk us through inflation and increasing rates are obviously having an impact on global markets.
Yeah. So, I mean, the real simple, way to explain it is, if you're paying more for your mortgage, if you're paying more at the grocery store, or, for your daily living expenses, naturally you've got less money to invest. And so investment markets, whether that's, share markets or whatever that is, generally will perform negatively in a period where inflation is high and while interest rates are rising. And so, we were actually, Billy and I were talking about it this morning. Depending on how this plays out or depending on how this goes, we may be seeing a period of time where, yes, interest rates are rising now, but at some point in the future, we may see reserve banks turn around the other way in order to prop up economies and actually, start decreasing rates again. Not any time in the near future, but that could potentially be a scenario to, help prop up the stock market or help prop up investment markets in the future. But at the moment, the real sort of focus for policymakers is inflation and is getting that under control, which is why we're seeing interest rates increase so that there's a further, drop in demand of goods and inflation is, coming down to sustainable levels.
We'll also talk about a little bit later some of the things that we talk to clients about in terms of preparing themselves for this sort of thing. And naturally, it's having some cash reserves and some cash buffers. So from that perspective, in terms of the impact that we're seeing on markets, if people are selling down investments that they've got to top up or increase their cash reserves, it's naturally putting downward pressure on the markets as well too, which is all part and parcel of what we're talking about around inflation, increasing interest rates and everything getting more expensive. But yeah, good explanation as to what's going on from that perspective as well too. Ordinarily, we think about, the cost of things with supply and demand in terms of finding a price equilibrium around, what a good or a service is charged at and what people are prepared to pay for it. I think the other thing that's adding a great amount of complexity to this, which we all know about and I guess we're aware of, but it's probably understated a little bit, is the supply chain issues that we're experiencing. So you may find, I guess you go to the grocery store and you can see that there's issues with certain goods that you want to buy. We all laugh about the toilet paper stuff back when COVID first hit and things like that. But right across the supply chain with all types of not only goods and materials, there's labour shortages as well too. Cost of building materials going through the roof, which is obviously in the media a fair bit in Australia at the moment as well too. And that's being compounded by really a couple of things. Obviously, COVID's still an issue, even though it seems that it's not in the media as much these days, but obviously it's still an issue. People are getting sick, needing to take time out of work. That's disruptive for manufacturing, for supply chains, for transport, for all of that. We've also got on a global scale the war in Russia and Ukraine. There's still a lot of uncertainty coming out of there, and obviously that's disrupting material and things coming out of that area of the world. And I guess the big one is China for a long period of time have been pursuing a COVID zero policy. So they would lock down entire cities until they got no COVID cases essentially. And that was a rolling issue that's causing, massive issues across the world because at the same time, factories are being shut down. And we as a global economy rely so heavily on the exports of China to provide material for us. And that's having a big impact as well too. And probably the last one is migration is still not happening to the same extent as what it was before COVID as well. So getting skilled labor, getting people here, everywhere you seem to go, I'm noticing it more and more these days, but you're noticing vacancies. You go to your local cafe, there's a sign on the window, or you'll talk to the people, they're understaffed or they've just started in their role. It's really difficult to get staff. So you go and add all of that together and it's not surprising that we've got an inflation issue.
Yeah, exactly. I don't think I've seen that ever really in my lifetime where there's been, signs on the door of people looking for staff and people, really struggling to find employees. It's certainly an impact on businesses. It's certainly an impact on the amount of money that they need to pay for employees, which, is a conduit in sort of the next point, which is looking forward, how do we navigate through this, or how do, markets and economies navigate through all of this? Now, obviously the supply chain issues, maybe not immediately, but at some point in time in the future, that's going to be alleviated. At some point in time in the future, we're going to have to go back to normal, and supply chains or supply of goods is going to have to start coming back to, some form of normality. Some of the concerns around this, however, is because unemployment is still so low, and because there's still, a fairly, high labour market at the moment, or a tight labour market at the moment, what we're seeing is that employers are having to pay more to attract and retain staff, which obviously has a negative impact on economies, has a negative impact on the profitability of businesses in the share market. But it also means that those companies, and especially the companies that can do that, are passing that cost on to consumers. So what you then see is, inflationary pressure all of a sudden is, even though you've sorted out the supply chain issue, and your manufacturing costs may start to come down. What you're now seeing is, okay, well, your costs of employees are also increasing. And so you may start to see a period of time where there's further pressure on inflation, not because of supply chain issues, but rather a resourcing issue.
Yeah, completely understand. Yep. Probably the only other thing with all of that as well too, and it ties into goods, the labour market, actually it touches everything, is high oil prices as well. Cost of oil is getting more expensive.
Sorry, I'm laughing just because I'm still remembering back to the period of time where oil prices were almost at they were at a negative.
They did go negative, yeah.
And now we're talking about, high oil prices and historical highs. It's crazy.
Although even though they went negative, I don't think I ever filled up petrol and the petrol station paid me to take the petrol away, right? So let's put it into some context. But I did fill up the other day and I paid like $200. I paid $2.25 for unleaded 91. Yeah.
Wow.
Yep. So obviously cost of oil has gone up and putting pressure on fuel, and that just adds to the inflationary pressure that we're seeing.
Yeah, and that's the production costs for businesses as well.
It adds right across the supply chain, right across, because everyone needs transport. You need fuel to run machinery. You need fuel to run plant.
You need fuel to transport goods. I mean, it's really in sort of absolutely everything. It's going to have a fairly dramatic impact. And so oil price is really another thing that's going to drive inflation, and what happens with oil prices is going to drive that as well.
I guess one of the last notes to sort of finish off on before we talk about what we can do to try and manage some of this is from a positive perspective.
We've been a bit doom and gloom today, haven't we, Bills?
Well, not necessarily doom and gloom. I mean, hopefully it's informative, right? And it's good to be informed, even if it is negative news, right? That's the slant that we'll take. But unemployment is low, is the lowest that it's been for a long, long time. It's very favourable because it means that with these challenges that we're facing, and that'll tie into some of the stuff that we do and talk to clients about in terms of how we manage this, but maintaining your employment and your household income essentially is critical in this instance. But that's a really positive thing for markets as well too, because it means that businesses are still producing goods and selling things and they're operating, and it means that they need to employ people in order to do that. So the wheels of the economy and the wheels of business and commerce are turning.
Yeah, exactly right. And I think that if you were to say, employment not at its current level and unemployment being at a high level, what you would see is some much more dramatic impacts to markets. And so fortunately, unemployment is still at very, very low levels. And what it does mean for households is that, yes, you might be paying more for things. Yes, your budgets and the disposable income or investable income might be squeezed, but compared to not having an income or having, one person out of two or a reduction in hours, whatever it is, but having less money coming into households would have really exacerbated what we're experiencing at the moment. And I guess, we've been talking, especially in Australia, about, wage growth or real wage growth being a bit of an issue over the course of, a few years. Now is when we're starting to see wages actually increase because of that, supply shortage in terms of employees. And so it is a period of normalization where, your debts were increasing and that was increasing at a rapid rate, and that was or your wages and income that you were receiving was not staying in line with that. Whereas now we're starting to see that, really normalize over time and starting to see some wage growth come into the market as well, which is definitely a positive thing for markets. Maybe not for inflation, but definitely for markets.
Yeah. So what do we do? Where to from here? We've gone and painted a picture of, I guess, the reality. And, if you are reading the media, if you're following what's transpiring here, we've got a way to go. There's an expectation that interest rates are going to continue to increase until inflation gets under control, which by all accounts, we're not there yet. So we'll just have to wait and keep an eye on that data. And central banks will continue to pull the interest rate lever until we start to see that turn. But what do we do? What's the message to our clients? What's the message to our listeners? What are some of the things that we're talking to people about to try and alleviate this and really give people some comfort around, yep, we're going into tougher times. Okay, sure, that's just part of an economic cycle, albeit nobody likes doing it, but there are some practical steps that we can take to try and ease this burden and ease the heartache that comes with it as well too. So, Andrew, what do we do?
Look, it all ultimately depends on your situation and where you're at. So that's the first thing that I sort of want to put out there is there is no solution for everyone. I mean,
it's different for everyone.
Absolutely right. The best thing and the most important thing to take out of this is, if you haven't already, this is a learning experience. If you put all of your money into markets, you've got no cash reserves, you don't have a choice. You need to sell assets in order to, sustain your essential expenses. There's really not much that you can do. You're forced to sell assets at depleted prices, which is not what you want to be doing in these investment cycles. But making sure that there's cash reserves, making sure that you're investing in good quality assets and investing over the long term, making sure that you're, not listening to the noise and, buying while everyone's saying things are great and selling while everyone's saying that things aren't good is the most important thing that you can do and prepare yourself for these market conditions. The first and foremost most important thing is making sure that you have cash reserves. If you don't have cash reserves, then any blip or any changes, they're going to impact you and they're going to force you to make decisions as opposed to you making informed decisions on your own. So that's definitely one of the most important takeaways out of this is if you're already in the position where you don't have those cash reserves and you're forced to make a decision, that's fine. You need to do what you need to do and you need to move on, but it has to be a learning experience that the sun's not always going to be shining. You're not always going to have rosy days. And so you need to make sure that you're preparing for the worst and there's buffers in place when, things like this do happen.
So take the lesson. That's the positive. If the universe is going to spank you and you're not prepared for it, there's a learning experience. So that's the positive out of it. I know, but cash reserves, right? So obviously cash reserves is something that, we've spoken about on the podcast before about having between, 3 and 6 months of expenses as cash reserves. It just helps you sleep at night. And in the environment that we're in and the environment that we're navigating through, that is prudent and front and center. Absolutely. The other one that springs to mind for me, which I don't want to generalize here, but should be fairly easy to do just because we're in a low unemployment environment, is maintaining your employment and your income. So household income is going to be critical, even in the face of rising costs, because there are some things that you can do around your expenses, but making sure that your household income stays the same. So essentially, continue to stay employed.
Yeah, and aside from the things that you can control, which, look, to some degree you can control it, sometimes it's out of your control. But aside from just, maintaining employment, not going to high risk occupations where, you might be earning a little bit more, but you could potentially, lose your employment. But aside from all of that stuff as well, this is a really important time to consider your insurance position. Income protection claims generally increase when there's market volatility. Making sure that you've got a consistent level of income irrespective of your house or irrespective of your ability to work. So if you're sick, you're injured, you're unable to work, you want to make sure that there's income coming in, because if your budgets are tightened, if you've got less, or if you're spending more money in terms of your mortgage, in terms of your household expenses, if all of that stuff is going to have an even greater impact, making sure that you have a risk mitigation strategy and an asset protection strategy if you were sick, if you were unable to work, is even more important in times like this.
Yep, definitely well said. Money management, being able to, I won't say control your expenses. I think the practical step here is being really almost laser focused on your household expenditure and where your money's going and paying more attention to it. And once again, seeing if there are areas that you can cut back on or tighten up on. That's, I guess, possible to a certain extent. There's obviously certain, you can go to the grocery store and limit your spending, but you still need to go and buy food, right? So you can minimize that to a certain level. But definitely from my perspective, getting a really clear understanding of where your money's going, so that way you can change, anything that you need to or minimize anything that you need to from that perspective. So your money management is definitely one from my end that also is a big box to tick during times like this.
The other question we will always get asked and is always a topic of conversation anytime that you're investing is, do I just sell out? Do I just sell my investments, sit on the sidelines, wait for all of this stuff to blow over and then buy back in at a future point in time? Again, depends on your situation, depends on where you're at in terms of your investment cycle. However, the general rule of thumb is absolutely not. If you're holding positions that are risky and have experienced a huge amount of volatility, that's not so much the same rhetoric. But if you're holding good quality assets, if you're expecting your investments to, continue to be a viable investment solution in the future, you hold your position. And the reason that you do that, and the reason that you don't sell out of your investments, is nobody knows when investment markets are going to come back. Is that going to be in 2 months' time, in 3 months' time, in 6 months' time? If you sell out of your investments, at what point do you actually rebuy and buy back into the market? If the market goes up, 5%, do you buy back in? Or is that just the market recovering a little bit before another crash? If the market goes up 10%, do you buy back in? At what point in time do you actually bite the bullet and buy back into the market? Even though when you zoom out, the lines look straight and they look like they're happening in pretty predictable cycles. When you're in it, it's moving up and down very quickly. And so knowing when to buy back in is is the difficult part and the risk that you're taking when you sell out of investment markets and try to sit on the sidelines.
I'm going to go one step further and say it's impossible to time it because we just don't know. And with the benefit of hindsight and history, you're right. Looking at a graph, it does look predictable and it's easy to turn around and say, yeah, I would have sold out here and I would have bought in here. But in all reality, it's really difficult to do. I don't know anybody who can do it consistently. I think it's a fallacy. Yeah. So from our perspective, once again, it's highly dependent on your situation, but from an investment perspective, diversification, having good quality assets, longer time frame, all of that makes sense. Dollar cost averaging, continuing to buy in, in a down market, you're buying more, your dollars going further because you are buying more of the underlying asset because it is cheaper. Investing for the long term as well too. All of those things make sense. The other thing that's probably understated, and it takes the right mentality and the right appetite, and having conviction in your decisions, but it's actually a really good time to be purchasing assets as well too, if you can stomach it. Once again, we've spoken about our mate Warren Buffett time and time again on the podcast about essentially doing the opposite of what everybody else is doing, but being greedy when others are fearful and fearful when others are greedy. Everyone's fearful at the moment. So with Warren's words, you should be greedy. And what that means is you should be seeking opportunity and buying into those assets. And
if you've made the right decisions in the past, like if you've got cash reserves, if you've, prepared for this, which is what you ultimately should be doing, there should be funds there available, ready for market events like this as well.
Andrew, it's interesting. The stuff that we're talking about today definitely sounds quite familiar in terms of what we practice and what we preach every single day to people. So hopefully a little bit of this messaging does sound familiar to our regular listeners. But look, hopefully that's left our listeners with, a whole heap of practical things around what you can do and some of the things that you should be thinking about in this environment, as well as an explanation as to what's going on with what we're seeing in the world that we're in at the moment.
Yeah. Bills, thanks again for another podcast. To our listeners, thanks again for tuning in. The details are in the show notes. So if you wanted to discuss any of this or anything in relation to investments, please feel free to reach out. And we look forward to catching you on the next podcast.
Thank you. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.